So I've mentioned a couple of times in other videos on the channel that the returns currently offered by the likes of bank savings and deposit accounts are virtually 0%. And what's really crazy about this is that throughout the course of this year, we've seen some of the highest savings rates amongst individuals in recent memory, which effectively means that people have more cash at their disposal by virtue of not having things to spend it on. And this correlates to the various industry shutdowns we've seen worldwide, which has led to an overall reduction in spending. So it's no surprise when you see the massive influx of retail investors into the stock market as people flock to try and generate higher returns on their cash stockpile than is currently offered by the bank. However, while many investors rush to invest in hot stocks such as Apple, Tesla, and Netflix, what they might not have considered is the very attractive investment that is real estate. How's it going, everyone? My name is Dan. You can call me Malone, and today we are going to be talking about real estate as an investment choice. Now, I know what you're thinking. Malone, I do not have the cash at the moment to be considering investing in real estate property. Well, fear not, friend, because we are going to be talking about real estate in the context of what is known as a real estate investment trust, or REIT for short. We're going to be taking a look at what exactly a REIT is, the different types of REITs that are available, how REITs themselves operate, and why REITs are an attractive investment choice. But before we begin, as always, if I could ask you to please drop a like on the video, it really does help me out a lot as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And if you are new around here, please do consider hitting that red subscribe button and turning the bell on for notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So to begin, we're going to discuss what exactly a real estate investment trust is. A REIT is effectively a company whose primary business involves the ownership or financing of real estate. Generally speaking, there are two types of REITs: equity REITs and mortgage REITs. An equity REIT is a company who acquires or builds real estate with the primary purpose of generating rental income from their properties. In short, these companies own properties which they lease out to tenants, and they earn money by collecting rental income from those tenants. Equity REITs can own properties across a wide number of industries, or they can be focused on one particular sector. The properties which the equity REIT owns is known as the portfolio of the REIT. By doing a quick Google search of equity REITs, you'll see that they operate in a wide number of industries such as healthcare, retail, offices, residential, and data centers. The main thing to remember is that equity REITs generate revenue by collecting rental income from the tenants of their properties. A mortgage REIT, or MREIT, on the other hand, generates revenue through interest income on its investments. A mortgage REIT will make money by lending cash to real estate owners, either directly through a mortgage or indirectly via the acquisition of mortgage-backed securities. Mortgage-backed securities are effectively a type of bond representing an interest in a pool of real estate loans. They're referred to as indirect investments because the mortgage REIT is effectively purchasing the loan or part of the loan that was originally issued by the bank to the real estate owner. This effectively gives the mortgage REIT an interest in both the interest and principal payments associated with the loan, even though they didn't issue the loan to the real estate investor in the first place. Banks will typically look to sell on loans as a way to free up capital so that they're not committed to parting with their cash for an extended period of time. Mortgage REITs make money on the spread between the interest that they earn on their investments and the interest that they pay on the money that they borrowed to make the investment in the first place. This typically means that mortgage REITs are very highly leveraged, meaning that they take on lots of debt in order for their business model to function. This makes mortgage REITs generally more of a riskier investment than equity REITs because mortgage REITs are subject to interest rate risk. Don't worry if all that information seems a bit overwhelming. All you need to know is that equity REITs generate revenue through rental income and mortgage REITs generate revenue through interest income. REITs can be traded on the stock market just like other companies, which makes them highly liquid investments. And this is one of the primary benefits of REITs over traditional real estate. With traditional real estate, it can take quite a while to actually purchase or sell a physical property, as well as having the additional drawback of having to put a large sum of money up front on the initial investment in the property itself. However, with REITs, you can obtain an interest in real estate property property using one simple, convenient, and highly liquid transaction. Furthermore, the cost of actually going ahead and purchasing a share in a REIT is obviously much lower than the cost associated with a down payment on a property. So apart from being cost effective and highly liquid investments, what else makes a REIT an attractive investment choice? The primary benefit associated with REITs actually stems from how REITs themselves operate in the first place. You see, being classified as a REIT from a corporate perspective has very attractive tax benefits. The primary tax benefit is that REITs don't have to pay corporation tax on either the income arising from their property rental business or on chargeable gains arising from the disposal of properties used in that rental business. However, a condition of this tax treatment is that 85% of the REIT's income must be distributed each year to its shareholders. So therefore, REITs typically pay very attractive dividends. And if you can catch the REIT at the right price, this can translate into very attractive dividend yields. A dividend yield is effectively the dividend that a stock pays you relative to its price. The higher the yield, the more dividend you receive per dollar invested in the REIT. However, as we mentioned before in other videos on the channel, chasing high dividend yields can be a risky exercise because the stock normally has a high yield for a good reason. A potential downside associated with the tax treatment afforded to REITs is that the REIT will only have 15% of its earnings left per annum to reinvest in the business, which can lead to slow growth and expansion in the case of smaller REITs, which again might translate to lower potentials for capital appreciation or increases in the REIT's stock price over time. So at this point in the video, I just want to show you two real life examples of REITs. Full disclosure, the two REITs that I'm going to show you are REITs that I'm currently invested in, but I do think that they serve as good examples of both equity REITs and mortgage REITs. So the first REIT I want to take a look at is Federal Realty Investment Trust, which is an equity REIT. Federal Realty is a REIT which primarily invests in shopping centers in the United States. Per their website, we own, operate, and develop award-winning retail environments and mixed-use neighborhoods in the nation's most desirable markets. So in this example, we can see that Federal clearly own their properties personally and generate revenues by letting those properties out to tenants who are typically high street retailers. If we take a quick look at Federal's financial statements for 2019, we can see that Federal had an interest in 104 predominantly retail real estate projects comprising 23.7 million square feet of gross leasable area. This vast portfolio is leased across 3,000 commercial leases and 2,700 residential leases. So you can see from that quick snapshot alone that a REIT such as Federal can give you a large interest in a wide number of properties at one convenient price. The second REIT I want to take a look at is Annaly Capital Management, which is a mortgage REIT. Annaly is one of the largest mortgage REITs in the world, and their primary business model involves investing in real estate related investments. Annaly generate revenue by earning the interest spread between the yield on the investments that it makes and the cost of borrowings used to make such investments in the first place. Annaly effectively borrows money on a short-term basis and uses this money to invest primarily in mortgage-backed securities, which gives them a right to interest and principal payments over time. One of the main objectives of Annaly is to monitor and manage their exposure to interest rate risk, which, as we mentioned before, is a principal risk of mortgage REITs. In summary, REITs give investors the opportunity to gain exposure to real estate assets without having to actually own or manage the properties themselves. They also provide investors with very attractive dividends, which are effectively legislated for by virtue of the taxation principles which govern REITs. However, like all asset classes, REITs are not without their risks. We already discussed how mortgage REITs are subject to interest rate risk, but equity REITs are also subject to significant risks in the form of non-payment of rent by tenants, business closures, and/or property vacancies. In fact, a lot of the risks associated with equity REITs came to fruition this year in light of recent events, which effectively led to a large-scale reduction and sell-off in the share price associated with equity REITs across the broader market. However, in my eyes, one of the principal benefits of REITs is that their share price is influenced by factors such as property prices, location, and industry demand. And these are factors which wouldn't necessarily influence the majority of stocks that you might hold in your portfolio. Therefore, REITs, in my eyes, not only provide easy access to diversification via the property portfolio that the REIT itself holds, but also adds another layer of diversification by way of being quite far afield from any other stocks that you might have in your portfolio. So I really do hope you've enjoyed the video here today. This video is more of a specific topic focusing in on one particular type of asset class. I personally find REITs very interesting, and so I wanted to make a video highlighting some of their key attributes. However, if you are unsure of any of the information you've heard today in this video, video, please do go ahead and contact a professional financial advisor for assistance. The information in this video and all other videos on my channel is for educational and entertainment purposes only and is not meant to constitute advice. Please never make a financial decision based on one person's opinion on the internet. So until the next time, leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.